Meet Sarah, a dedicated teacher, working hard every day to shape young minds. She loves her job, the kids, and the impact she makes. But like millions of us, every payday, Sarah faces a recurring puzzle: the deductions. Her gross pay looks promising, but after federal, state, and local taxes, plus Social Security and Medicare, the net amount feels smaller. It's a universal experience, this feeling of money earned, only to see a significant portion disappear before it even hits your bank account. It leaves many wondering, is there a way to earn without losing so much to taxes? For centuries, governments have collected taxes to fund public services: roads, schools, defense, healthcare. It's a fundamental part of how societies function. But for individuals, the sheer complexity and the constant bite out of earnings can feel overwhelming. Many assume that nearly all income is taxed, and that's just the unavoidable reality of earning money. This perspective, while understandable, overlooks a fascinating and often underutilized area of personal finance: the world of tax-free income. It's not a loophole, but a set of rules designed to encourage certain behaviors and investments. Imagine being able to keep every dollar you earn from certain sources, without a single cent going to income tax. Sounds like a dream, right? This video will demystify tax-free income sources, revealing surprising truths and common misunderstandings. We'll introduce you to everyday people who've leveraged these opportunities, and provide concrete examples and short anecdotes to illustrate how they work. Our goal is to build your understanding step by step, empowering you with knowledge that many believe is only for the wealthy or financially savvy. Get ready for an aha moment that could change how you think about your money. Before we dive into tax-free, let's clarify some basic terms. What exactly is income? In simple terms, income is any money or value you receive. This can come from many sources: your salary from a job, profits from selling something, rent from a property, interest from savings, or dividends from investments. The government typically considers most forms of income as taxable, meaning a portion of it must be paid to the tax authorities. Understanding this baseline is crucial because tax-free income means exactly what it sounds like: money that is exempt from this usual tax obligation. And what are taxes? Taxes are mandatory financial charges or other levies imposed on an individual or a legal entity by a government. They are not voluntary payments but are legally enforced. The most common type we discuss is income tax, which is a tax levied by governments on financial income generated by all entities within their jurisdiction. But there are also sales taxes, property taxes, estate taxes, and more. When we talk about tax-free income, we're primarily referring to income that is not subject to income tax, although other types of taxes might still apply in specific situations. It's vital to distinguish between tax-free and tax-deferred, as these terms are often confused. Tax-free means you never pay income tax on the money. It goes directly into your pocket or account without the tax collector taking a cut. Tax-deferred, on the other hand, means taxes are postponed until a later date, usually retirement. You don't pay taxes now, but you will pay them when you withdraw the money. While both offer tax advantages, their mechanics and implications for your long-term financial picture are quite different. We're focusing squarely on the truly tax-free scenarios here. Let's start with a common, relatable scenario: gifts. Imagine receiving a generous birthday gift of cash from a family member, say $1,000. Do you pay income tax on that? For the vast majority of people, the answer is no. Gifts, whether cash, property, or other assets, are generally considered tax-free income for the recipient. This is a common and often overlooked way money can flow to you without being taxed. However, there are limits and nuances, primarily affecting the giver of large gifts, not the receiver. For most everyday gifts, you can receive them without a tax worry. Here's a crucial misunderstanding: many people worry about a gift tax for recipients. The truth is, the U.S. federal gift tax applies to the giver, not the recipient. In 2024, an individual can give up to $18,000 per year to any number of people without having to report it to the IRS or use up any of their lifetime gift tax exemption. Only gifts exceeding this annual exclusion trigger reporting requirements for the donor, and even then, actual taxes are rarely paid unless someone gives away millions over their lifetime. So, as a recipient, that $1,000 birthday gift is completely yours, tax-free. Similar to gifts, money or assets received as an inheritance are often tax-free for the recipient at the federal level. When a loved one passes away and leaves you something in their will, you generally do not pay income tax on that inherited amount. This often surprises people, as many assume inheritance is heavily taxed. The primary tax concern with inheritance is usually the estate tax, which is levied on the estate of the deceased before the assets are distributed to heirs. So, if your grandmother leaves you $50,000, that money arrives in your hands free from federal income tax. The estate tax, sometimes called the death tax, is a tax on the right to transfer property at death. It typically only applies to very large estates. For example, in 2024, the federal estate tax exemption is over $13.6 million per individual. This means an estate must be worth more than that amount before any federal estate tax is due. Most estates fall well below this threshold. Some states also have their own estate or inheritance taxes, which can apply at lower thresholds. But for the vast majority of inheritors, the money they receive is free from income tax, allowing them to use it directly for their needs. Another significant source of tax-free income for beneficiaries is life insurance payouts. When someone passes away and you are the designated beneficiary of their life insurance policy, the lump sum payment you receive is generally free from income tax. This is a crucial financial tool designed to provide financial security to loved ones after a loss. Imagine Emily, whose father passed away unexpectedly. The $200,000 life insurance payout allowed her to pay off student loans and support her family without the added burden of income taxes. It was a lifeline, truly tax-free. For students, scholarships and fellowships can be a game changer, and here's a pleasant surprise: they can also be tax-free. If you receive a scholarship, fellowship grant, or tuition reduction, the portion used for qualified education expenses is typically not taxable. Qualified education expenses include tuition and fees, as well as books, supplies, and equipment required for courses. However, any amount used for non-qualified expenses, like room and board, travel, or optional fees, is considered taxable income. This distinction is vital for students planning their finances. Now, let's explore a powerful tool that offers not just one, but 3 tax benefits, including a crucial tax-free component, the Health Savings Account, or HSA. An HSA is a savings account that allows you to save money for healthcare expenses on a tax-advantaged basis. To be eligible, you must be enrolled in a high-deductible health plan, or HDHP. The magic lies in how you can use the money. Contributions are tax-deductible, the money grows tax-free, and most importantly for our topic, qualified withdrawals for medical expenses are entirely tax-free. It's a triple tax benefit. Consider Mark, who uses his HSA to save for future medical costs. He contributes a portion of his paycheck, pre-tax, reducing his taxable income. Over the years, that money grows, untouched by taxes. Then, when he needs to pay for a doctor's visit, prescription, or even dental work, he withdraws the funds. That withdrawal, covering a qualified medical expense, is completely tax-free. This isn't just about saving for emergencies, it's about strategically managing healthcare costs for decades. It's a remarkable way to have funds readily available for health needs without ever having them taxed. For retirement planning, the Roth IRA is a superstar when it comes to tax-free income. Unlike traditional IRAs where contributions are often tax-deductible, Roth IRA contributions are made with after-tax money. This means you don't get an upfront tax break. But here's the powerful trade-off: once your money is in a Roth IRA, it grows completely tax-free, and qualified withdrawals in retirement are also entirely tax-free. Imagine saving for 30 years, watching your money compound, and then taking it all out without ever paying a cent in income tax on the gains. That's the Roth advantage. What constitutes a qualified withdrawal from a Roth IRA? There are 2 main conditions. First, you must be at least 59 and a half years old. Second, you must have held the Roth IRA for at least 5 years, a rule known as the 5-year rule. If both conditions are met, all your withdrawals, both your original contributions and all the accumulated earnings, are completely tax-free. This offers incredible peace of mind for retirees, knowing that a significant portion of their retirement income won't be subject to unexpected tax bills. It's a strategic move for long-term financial freedom. To illustrate the Roth IRA's power, imagine a young professional, David, who starts contributing $500 a month to a Roth IRA at age 25. By age 65, with an average annual return of 7%, he would have contributed $240,000. But due to compounding, his account could grow to over $1.2 million. The remarkable part? Every dollar of that $1.2 million can be withdrawn tax-free in retirement. If that same growth happened in a taxable account, he'd pay capital gains taxes on nearly $1 million in earnings. The Roth IRA offers substantial savings over a lifetime. Education is a huge expense, but a 529 plan can help families save for it with significant tax advantages. A 529 plan is a tax-advantaged savings plan designed to encourage saving for future education costs. While contributions aren't federally tax-deductible, the money grows tax-free, and qualified withdrawals for education expenses are also tax-free at the federal level. Many states also offer a state income tax deduction or credit for contributions. This means you can save for a child's college, K-12 tuition, or even your own continuing education, and potentially avoid taxes on all the gains. Consider the Lopez family, who started a 529 plan when their daughter, Sophia, was born. They contributed consistently over 18 years. The market grew, and their contributions significantly increased in value. When Sophia was ready for college, they withdrew money to pay for her tuition, fees, and even room and board. Because these were qualified education expenses, all those withdrawals, including the substantial investment gains, were completely tax-free. The 529 plan allowed them to save hundreds, even thousands, of dollars in taxes they would have otherwise paid on investment earnings. For investors, municipal bonds, or munis, offer a unique opportunity for tax-free income. These are debt securities issued by state and local governments, or their agencies, to finance public projects like roads, schools, or hospitals. When you buy a muni bond, you're essentially lending money to the government, and in return, they pay you interest. The interest income you earn from these bonds is typically exempt from federal income taxes. If you buy a bond issued in your own state, the interest is often also exempt from state and local income taxes. This makes them very attractive for certain investors. While the interest rates on municipal bonds are often lower than taxable corporate bonds, their tax-free status can make their tax-equivalent yield higher for investors in higher tax brackets. For someone in a 24% federal tax bracket, a 3% tax-free muni bond might be equivalent to earning 3.95% on a taxable bond. This means the higher your income and tax bracket, the more beneficial municipal bonds become, as they shield a larger portion of your earnings from the IRS. It's a sophisticated yet accessible way to generate income without the taxman taking a share. One of the largest, yet often overlooked, tax-free income sources comes from selling your primary residence. When you sell a home for more than you bought it for, that profit is called a capital gain. Usually, capital gains are taxable. However, homeowners can exclude a significant amount of profit from federal income tax if it was their primary residence. Specifically, individuals can exclude up to $250,000 of gain, and married couples filing jointly can exclude up to $500,000, provided they meet certain ownership and use tests. This is a massive tax break for most homeowners. To qualify for this exclusion, you must have owned and used the home as your main residence for at least 2 out of the 5 years preceding the sale. This is known as the ownership and use test. For example, if Alex and Maria bought their first home for $300,000, lived in it for 7 years, and then sold it for $750,000, they would have a profit of $450,000. Because they are married and meet the tests, that entire $450,000 profit is completely free from federal capital gains tax. This single tax provision can save homeowners hundreds of thousands of dollars, making it incredibly powerful. Beyond these major categories, there are several other less common but equally important sources of tax-free income or benefits. For instance, certain disability benefits, such as those from the Department of Veterans Affairs or workers' compensation payments, are generally tax-free. Qualified foster care payments are typically not taxable. Also, the first $10,000 of forgiven student loan debt, under certain federal programs, became tax-free income temporarily. While these are often specific to certain life circumstances, they represent critical financial lifelines that avoid the tax burden. Here's a common point of confusion: people sometimes mistake tax credits for tax-free income. While both are beneficial, they work differently. A tax credit directly reduces the amount of tax you owe, dollar for dollar. For example, a $1,000 tax credit reduces your tax bill by $1,000. If your tax bill was $3,000, it becomes $2,000. Some credits are even refundable, meaning if the credit is more than your tax bill, you get the difference back as a refund. While this increases your net money, it's not income you earned that was tax-free, it's a reduction in taxes you owed. The child tax credit is a great example. For 2023, this credit can be worth up to $2,000 per qualifying child. If a family owes $3,000 in taxes and qualifies for a $2,000 child tax credit, their tax bill drops to $1,000. If part of the credit is refundable, they might even get money back. While this puts more money in the family's pocket, it's distinct from income that was never taxed to begin with. Understanding this difference helps clarify the true meaning of tax-free income and how various financial benefits impact your bottom line. One of the most pervasive myths we encounter is the belief that all income is taxed. This video has shown you that this simply isn't true. From gifts and inheritances to strategic savings vehicles like Roth IRAs and HSAs, and even the profit from selling your home, there are numerous legitimate ways to receive or generate income without owing federal income tax on it. This myth often prevents people from exploring these beneficial options, assuming they are too complicated or only for the super-rich. The reality is far more accessible than most imagine. Another common misunderstanding is that anything tax-free must be a loophole or somehow shady. This couldn't be further from the truth. The tax-free provisions we've discussed are all explicitly written into tax law by Congress. They exist for specific policy reasons: to encourage saving for retirement, Roth IRA; to support education, 529 plans, scholarships; to help families with healthcare costs, HSA; or to simplify the tax burden on everyday transactions like small gifts or life insurance. These are legitimate tools for financial planning, not obscure tricks. And here we arrive at our aha moment: tax-free income isn't about avoiding taxes illegally, it's about strategic financial planning within the rules. It's about making informed choices that align with your financial goals, whether that's saving for retirement, a child's education, future healthcare, or even selling your home. It's about recognizing that the tax system, while complex, also offers avenues to legally keep more of your hard-earned money. This knowledge empowers you to be more intentional with your finances, reducing your tax burden over a lifetime. Perhaps the most surprising truth is that these tax-free opportunities are accessible to almost everyone, not just the wealthy. A young student can receive a tax-free scholarship. A working-class family can benefit from a Roth IRA or a 529 plan. Homeowners across income brackets can utilize the capital gains exclusion. Even modest gifts can be received tax-free. It's not about how much you earn, but how wisely you manage and position your money. This knowledge is a powerful equalizer, giving everyday people the tools to build wealth more efficiently. Let's revisit the Roth IRA. Even if you don't earn a high income, contributing even a small amount regularly can make a huge difference over decades due to tax-free compounding. If you contribute $100 a month from age 25 to 65, that's $48,000 in contributions. With that same 7% annual return, it could grow to over $240,000, all tax-free at withdrawal. That's $250,000, completely free of income tax, built on consistent, accessible contributions. It's a testament to patience and smart planning, not just high earnings. The HSA also has a lesser-known benefit for retirement. While primarily for medical expenses, after age 65, you can withdraw HSA funds for any purpose without penalty. While these non-medical withdrawals are then taxed as ordinary income, like a traditional IRA, withdrawals for qualified medical expenses remain tax-free, even in retirement. This flexibility makes the HSA a powerful dual-purpose account, healthcare savings now, and an additional retirement fund later, offering immense peace of mind about future health costs, a major concern for many seniors. Even if you don't have children, a 529 plan can be used to fund your own continuing education, professional certifications, or even vocational training. Imagine pursuing a new career path or upgrading your skills without worrying about taxes eating into your education savings. This adaptability makes 529 plans a versatile tool for lifelong learning. It's not just about traditional college degrees, it's about investing in yourself and your future earning potential, with the added benefit of tax-free growth and withdrawals for those qualified expenses. The journey through tax-free income sources isn't just about finding specific accounts, it's about reframing your entire financial mindset. Instead of passively accepting every tax deduction, you can actively seek opportunities to make your money work harder by shielding it from taxes. This proactive approach can lead to significantly more wealth accumulation over time. It's about becoming a savvy participant in your financial life, understanding the rules, and using them to your advantage within legal and ethical boundaries. The cumulative effect of embracing tax-free income strategies can be truly transformative. Over decades, the money you save in taxes, compounded year after year, can mean the difference between struggling to meet financial goals and comfortably achieving them. Imagine a retirement where your healthcare costs are covered, your kids' education is paid for, and you have ample savings, all thanks to strategic choices made today that allowed your money to grow and be accessed tax-free. This isn't about getting rich quick, but about securing a stable and prosperous future. Remember, while the concept of tax-free income is powerful, understanding the specific rules for each source is crucial. Eligibility criteria, contribution limits, withdrawal conditions, and annual exclusion amounts can change over time. Staying informed, perhaps by checking official IRS publications or consulting reputable financial news sources, will ensure you're always making the most informed decisions. Knowledge truly is power when it comes to managing your money effectively and reducing your tax burden. For complex financial situations, or if you simply feel overwhelmed, don't hesitate to seek professional advice. A qualified financial advisor or tax professional can help you navigate the intricacies of tax law, assess your individual circumstances, and tailor a strategy that maximizes your tax-free opportunities. They can provide personalized guidance to ensure you're making the best decisions for your specific goals and risk tolerance. Think of them as your financial GPS, helping you chart the most efficient course. You've embarked on a journey to understand a vital part of personal finance often shrouded in mystery. From Sarah's initial frustration with deductions to realizing the powerful potential of tax-free income, we hope this video has empowered you. The aha moment isn't just about realizing tax-free income exists, but understanding that you have the power to strategically integrate these opportunities into your life. It's about taking control, making conscious decisions, and working smarter with your money, rather than simply working harder for it. To recap, we've explored how gifts, inheritances, and life insurance payouts are generally tax-free for recipients. We delved into scholarships for qualified expenses, the triple tax benefits of HSAs, and the future tax-free growth of Roth IRAs. We also uncovered how 529 plans save for education and how municipal bonds offer tax-exempt interest. And let's not forget the massive capital gains exclusion when selling your primary residence. These aren't just facts, they are pathways to a more secure and prosperous financial future for you. The journey to financial mastery is ongoing, but understanding tax-free income sources is a huge leap forward. Start by exploring which of these opportunities align with your current life stage and financial goals. Research the specifics, talk to experts, and begin implementing these strategies. Every small step taken today can lead to significant tax savings and wealth accumulation tomorrow. Don't let the complexity deter you, let the potential empower you. Your financial future is in your hands, ready to be shaped. What will be your next step? Perhaps you'll look into opening a Roth IRA, or contributing more to an existing HSA. Maybe you'll consider a 529 plan for a loved one's education, or simply be aware of the tax implications of receiving a large gift. Whatever it is, remember that knowledge is your most valuable asset. Armed with this understanding, you are better equipped to navigate the financial landscape and build a future where more of your money stays where it belongs, with you. Thank you for watching.